I know what you're thinking. It's the holidays. You've earned your break. You should be with family, enjoying the season, disconnected from market chaos. And honestly, that was my plan too. But something just crossed my desk from the Asian markets that demands immediate attention. This isn't speculation. This isn't a chart pattern. This is hard data showing a fracture in the global silver market that cannot be ignored. Right now, as I'm recording this, physical silver in Shanghai is trading at $80.53 per ounce. Not a typo, not clickbait, $80.53. Meanwhile, the paper price in New York sits at $71.26. That's a $9.27 premium. And if you understand what that number actually means, you'll realize we're watching something break in real time. Let me walk you through the mathematics so there's no ambiguity. The Shanghai Futures Exchange front-month contract, designated AG2601, settled at 181 yuan and 45 fen per kilogram before their holiday break. I'm using the current USD CNY exchange rate of 7.006. Take the Shanghai price of 181 yuan 45 fen per kilogram. Convert to US dollars. 181.45 divided by 7.006 equals $25.89 per kilogram. Convert kilograms to troy ounces. There are 32.15 troy ounces per kilogram. 25.89 divided by 32.15 equals $80.53 per troy ounce. The math is undeniable. The world's largest manufacturing economy, the country that actually consumes silver to build solar panels and electric vehicles and electronics, is valuing the metal at $80. Meanwhile, the paper market in New York is pretending the price is $71. Here's why this should terrify anyone who understands market mechanics. In a normally functioning market, this spread cannot exist. If silver costs $9 less in New York than Shanghai, every bank, every hedge fund, every algorithmic trading system should be executing the same trade. Buy silver in New York at 71. Ship it to Shanghai. Sell it for 80. Collect $9 per ounce in risk-free profit. This is called arbitrage. It's the gravitational force that keeps global prices aligned. Typically, spreads might reach 50 cents, maybe $1, during extreme volatility. But $9.27? That means gravity has been suspended. The arbitrage mechanism is broken. Why aren't the banks closing this gap? There's only one logical explanation. They can't. Either the metal in New York isn't actually available to be moved, or the logistics chain has completely collapsed under Eastern demand. We are witnessing a market where paper price and physical price have officially divorced. This brings us to why I'm interrupting your holiday. Tomorrow morning, US markets reopen for what traders call Ghost Week. The low volume, illiquid days between Christmas and New Year, when senior traders are on vacation and markets operate on skeleton crews. You have a market in New York with essentially zero liquidity. And you have a $9 vacuum pulling price higher towards Shanghai's reality. That gap must close. And since China isn't lowering their price because they're experiencing shortage, New York has to rise. We're staring at the setup for a massive gap higher when the algorithms wake up and recognize how severely mispriced they are. Let me explain exactly why this premium exploded. We have verified reports about specific industrial sectors in China, solar and electric vehicles, primarily that are panic hoarding metal regardless of price. If this were speculative mania, the buying would be coming from retail traders chasing charts. But the volume appearing on Shanghai Futures Exchange isn't originating from retail accounts. It's coming from commercial hedging accounts. The entities buying silver in China right now aren't hedge funds, they're factories. We are witnessing an industrial run on physical supply. And in an industrial run, if you don't secure your metal, your factory shuts down. Your workers go home. Your company dies. That's why they're paying $80, because the alternative is zero production. Let's examine the first driver, solar photovoltaics. China controls over 80% of the global solar panel manufacturing supply chain. For years, Western analysts insisted the industry would engineer silver away. That narrative just collapsed. Recent data from the China Photovoltaic Industry Association shows that despite elevated silver prices, silver consumption per watt has stopped declining. The industry has hit the thrifting wall. You cannot reduce silver content further without sacrificing panel efficiency. And here's the critical development: TOPCon technology. The industry is rapidly transitioning to new TOPCon and HJT cells. These advanced high-efficiency panels require 50 to 80% more silver per unit than previous generation technology. So at the exact moment global mine supply is stagnating, the Chinese solar industry needs more silver per panel, not less. We are seeing verified reports from Jiangsu province that factories are bypassing standard supply chains entirely. They're going directly to Shanghai Futures Exchange and taking physical delivery of 15-kilogram bars. They're melting down investment-grade bars to convert them into industrial paste. This is desperation behavior. But if solar were the only driver, the market might absorb it. The real panic is coming from the electric vehicle sector. Earlier this week, reports circulated about production timelines for Samsung's new solid-state batteries. 600-mile range, 9-minute charge time, revolutionary performance. But the anode isn't constructed from graphite. It's made from a silver carbon composite. A standard electric vehicle uses approximately 20 to 50 grams of silver. A solid-state electric vehicle uses up to 1 kilogram, 1,000 grams. That's a 20 to 50 times increase per vehicle. Now connect this to China. China is the world's largest EV manufacturer. BYD, CATL, NIO, XPeng. They're not going to allow Samsung to monopolize next-generation battery technology. We're observing massive block purchases of silver originating from Shenzhen and Ningde. These companies aren't manufacturing solid-state batteries today, but they are strategic hoarders. They understand that to build millions of these vehicles in 2027 and beyond, they need to secure silver supply now. When BYD buys silver, they don't purchase 5,000 ounces. They purchase 5 million ounces. And they're price inelastic. They don't care whether it's $70 or $80. They care about locking supply chains. So we have solar panic and EV hoarding occurring simultaneously. Let's examine Shanghai Futures Exchange warehouse stocks. In 2021, these warehouses held over 3,000 tons of silver. As of the December 23rd close, they're down to less than 800 tons. We're seeing a 75% drawdown in visible inventory. But the registered warrants metal actually available for immediate delivery is approaching zero. This is why we're seeing backwardation. Market participants will pay more for metal today than for metal delivered next month. Right now, in China, spot price trades significantly above forward prices. The factories are screaming, "Don't promise me metal in February. Give me the metal today." This backwardation is the heartbeat of a squeeze. It signals that physical availability at current prices has effectively disappeared. Now look back at the West. Traders in New York are analyzing charts. They're watching dollar movements. They have absolutely no awareness of what's happening on factory floors in Jiangsu. They think silver is a currency play. China knows silver is a strategic technology metal. The West is selling paper silver at 71 because they think it's expensive. The East is buying physical silver at 80 because they know it's cheap compared to shutting down a gigafactory. Every ounce sold on COMEX at 71 is being absorbed, refined, and shipped to Chinese warehouses where it will never circulate in Western markets again. So what happens tomorrow when Ghost Week begins? You have a market in New York with zero liquidity. Inventory is drained. COMEX saw 1.4 million ounces withdrawn in a single day last week. You have a $9 price gap with Shanghai. If a Chinese industrial buyer decides to hedge their January production tomorrow morning, they'll hit the COMEX ask. And because the order book is empty, price will skip from 72 to 75 to 78 in seconds. They'll close the arbitrage gap by force. This premium explosion isn't a glitch. It's the sound of industrial supply chains snapping. There's a massive gap in this story we haven't addressed. If there's $9 profit on every ounce, why isn't anyone capturing it? These are institutions designed to extract profit from the smallest inefficiencies. If they identify an asset trading at 71 in New York and 80 in Shanghai, their entire existence is predicated on closing that gap. It's literally free money, risk-free arbitrage. So why is the gap widening? The answer is terrifyingly simple. They cannot move the metal. We're witnessing catastrophic breakdown in the physical logistics of the silver market. You can trade paper contracts in milliseconds, but you cannot teleport a 1,000-ounce bar of silver, and right now, that supply chain is broken. We've received reports from logistics sources handling secure air freight from London and New York. They're reporting complete blockage, not because planes aren't flying, because the metal isn't appearing at loading docks. Bullion banks attempting arbitrage are calling vaults and refineries, and for the first time in decades, they're being placed on wait lists. Refineries say, "We're booked for 6 weeks." Vaults say, "We need 48 hours to locate that bar." When a vault operator claims they need time to locate your metal, it means one thing: the metal isn't where it's supposed to be. Or it's been rehypothecated, leased out, and they're scrambling to find replacement bars. While everyone was distracted by holidays, COMEX released its December 23rd inventory report. In a single day, the Asahi Vault saw withdrawal of over 1.4 million ounces from registered category. Registered silver is the lifeblood of the exchange. Metal fully warranted and available for immediate delivery. When you observe 1.4 million ounces leaving registered at Asahi, plus 600,000 leaving JP Morgan, plus 200,000 leaving CNT, all the same day, you're watching a bank run. These entities are taking physical possession. And this explains why the arbitrage gap won't close. The inventory banks would use to ship to China is already being extracted by Chinese buyers. It's a death spiral for COMEX. The more the premium rises in Shanghai, the faster metal leaves New York. The faster metal leaves, the less liquidity exists. And the less liquidity, the more prices disconnect. We're also hearing unverified but concerning reports from London market participants. The LBMA is allegedly experiencing unusual delays in processing large allocation requests. What should take days is reportedly taking weeks. If London is experiencing similar inventory stress as New York, the implications are staggering. London has traditionally been the deepest pool of physical silver liquidity in the Western world. If that pool is draining simultaneously with New York, there's nowhere left for the paper market to source metal for delivery. If London is out of metal, the game is over. London is the vault of last resort. If London's float is exhausted, then COMEX becomes an island, a paper market trading derivatives of ghosts. This is why Ghost Week is so dangerous. We have a hollowed-out market in New York, and tomorrow morning, electronic markets reactivate. The only variable that can adjust is price. The New York paper price must rise to meet reality. It cannot remain at 71 when the physical world transacts at 80. The banks are trapped. They're short paper contracts, but they've lost control of physical inventory. We are witnessing the end of the paper price era. For 50 years, New York told the world what silver was worth. Today, that authority has been revoked. Tomorrow morning, we're about to witness collision between two forces: the liquidity vacuum of Ghost Week and the $9 Shanghai premium. Let me explain the battlefield. 90% of senior traders are on vacation. Trading desks are managed by skeleton crews and automated algorithms. The order book is paper thin. It takes very little capital to move price a long distance. Now enter the high-frequency trading algorithms. They only know mathematics. The algorithm sees Shanghai 80.53, New York 71.26. Instruction: buy until prices equal. Usually a human would intervene, but the humans are skiing. The algorithms run on autopilot. Here's how the squeeze happens. The trigger: a Chinese industrial hedger places a large buy order. The vacuum: this hits COMEX with no sellers at 71.30. The slip: order slips instantly to 72. The algo chase: HFT bots see the jump, calculate arbitrage, and pile in. The air pocket: massive buying hits an empty room. Price doesn't tick up. It gaps, skips 73, skips 74, prints 75 within minutes. But it gets worse for banks. Thousands of call options are open at 72 and 75 strikes. If price gaps to 75, banks must buy futures to hedge losses. But buying more pushes price higher, forcing more buying. It's a feedback loop from hell in a market with no inventory to slow it down. Here's what you need to watch tomorrow. If New York opens flat at 71, it's a trap. The explosion is delayed until volume returns January 2nd. But if New York opens at 73 or higher, the squeeze has begun. If we break 72.50 in the first hour, we could see 78 before lunch. The market is trying to tell you something. The $71 price is fiction. The $80 price is reality. And fiction is about to be violently corrected. Let's assume the squeeze happens and New York wakes up at 80. Skeptics will say it's over. They're wrong. $80 is not the ceiling, it's the new floor. What we're witnessing isn't just a trade, it's the end of an era, the end of Western discount pricing. For 50 years, New York and London determined silver's price. Today, with Shanghai at 80.53, that era is over. Pricing power has shifted east. Once New York matches the $80 price, the suppression mechanism is broken forever. To understand why price goes higher, you need to understand CEO psychology. For 30 years, global industry operated on just-in-time inventory. You didn't stockpile silver, you trusted the market. But what happens when the premium hits $9? When vaults run dry? Trust evaporates. We're moving from just-in-time to just-in-case. Every industrial CEO observing this is thinking, if I don't buy 6 months of inventory now, I might not get it later. This creates a hoarding supercycle. It doesn't matter if price is $80. If you're building a $50,000 electric car needing $80 worth of silver, you pay it. The cost is negligible relative to the vehicle price, but the metal is absolutely critical to production. Without it, the entire assembly line stops. Silver is inelastic. And in an inelastic market, when confidence breaks, price doesn't double, it adds a zero. The bank's entire game relied on one bluff. If you buy futures, we can deliver metal. The $80 Shanghai price calls that bluff. If banks try shorting at 80, arbitrage bots will buy their paper, take delivery, ship to China. Banks cannot suppress price anymore. The artificial ceiling that kept silver below 30, then below 50, has been removed. We're entering pure price discovery. And in price discovery, price must rise high enough to either destroy demand or create supply. To destroy demand, solar and tech need silver. They can't switch. Demand is sticky. To create supply, it takes 10 years to build new mines. For the next decade, price has to do the heavy lifting. $80 is just the wake-up call. 125 to 150 is the equilibrium needed. So here's the forecast. We'll see a bifurcated market dissolve into unified bull market. Right now we have two prices, 71 and 80. By January, we'll have one price, 80 plus. Once that merge happens, Western investors will realize the shortage is real. When they see banks are powerless, when they see 80 holding as support, investment capital will flood in. Industrial panic provides the floor. Logistics breakdown creates the squeeze. Investment FOMO supplies the rocket fuel. This is the recipe for a move that makes 1980 look like a warm-up. But there's danger of psychology. When silver hits 80, your brain will scream, "It's too high, sell!" You're conditioned to think 30 is high, 50 is the top. You need to rewire for new reality. In a world where the dollar is dying and China pays 80 for strategic metal, 80 is cheap. 80 is the new 20. If you sell at 80, you're trading scarce strategic asset for depreciating paper currency right as the asset is about to go vertical. You're exiting the lifeboat just as the ship begins its final descent. The squeeze is inevitable. The gap will close. Price will re-rate. The question isn't if. The question is, are you positioned for what comes next? Because we're watching the end of the paper silver era happen in real time. The financial institutions that have controlled price discovery for half a century are losing that control to industrial buyers who need physical metal to keep their factories running. This isn't a temporary dislocation. This is a permanent shift in how silver gets priced globally. And when history looks back at this moment, the only question that will matter is whether you recognize the pattern before it was obvious to everyone else. The $9 premium in Shanghai isn't noise. It's signal, the loudest signal the silver market has sent in decades, and it's screaming that everything is about to change. Tomorrow morning, when those markets reopen, we'll see whether the paper price bends to reality or whether it breaks completely trying to maintain the illusion.